Hi, I'm Owen from Rask Australia. In this video, I'm going to explain to you the 5 key things you need to understand, or the 5 key phrases and strategies you need to understand if you're going to be investing in the share market for the long term. This is one video, and I'm going to try and fit all 5 things, and these are essential things, into one video. So if you need any further guidance on any of these things, please see the links below this video to more resources. The first thing to understand is this concept called diversification. You've probably heard the phrase diversification followed by the words, "Don't put all of your eggs in one basket." Now that phrase is loosely correct. Diversification is about spreading all of your investments or spreading your money across many different investments in your portfolio. In the times gone by, if you went and saw a stockbroker, they might have mentioned something called the race to 30. And the race to 30 was this idea that when you're starting a portfolio, you should be trying to get to 30 different investments as quickly as you can. And the reason that they would say that is because if one thing really bad happened to one of your companies, let's say you invest in a company, you've got 30 of them, and one of them just went straight to zero tomorrow. Because you're diversified across 30 different investments, the other 29 investments typically shouldn't be affected to that extent. So let's say you had $100,000 and in each position you had around $3,000. If you invested $100,000 and that one share went to zero tomorrow, you'd still be left with around about $97,000, which isn't too bad. But then let's imagine that you had only one investment and that one investment went straight to zero tomorrow. Obviously your $100,000 is completely gone because all of it is in one different share or ETF or different type of investment. So that would be an example of really poor diversification. Nowadays, you don't necessarily have to get to 30 investments to make it well diversified because we have these things called exchange traded funds or ETFs. And ETFs, whereas you could buy an individual share, an ETF baskets together all of the different shares for a particular area or a particular region of the world. And it could be more than just shares actually. You could have shares, you could have bonds, you could have commodities like cash, you could have even property securities, all different types of things in this one basket. And instead of buying an individual share, you can just buy a slice of the entire basket. So with one investment into a good low-cost ETF, what you're actually getting is exposure to all of those things inside the basket. And that is a way to become diversified pretty quickly. In another video, I'll explain to you how to combine all of your investments to be well diversified if you're starting from scratch. So what's the second concept that we want to talk about today? What is the ASX 200? Chances are, if you've watched the morning news or the evening news, you would have seen these 6 digits, the ASX and 200, followed by a number or maybe even a percentage symbol. Now what the ASX 200 is it's 200 companies, so that's where the 200 comes from, on the Australian Securities Exchange, and that's where the ASX comes from. And what it represents are the share prices of the top 200 companies on the Australian share market. So then when the news anchor reads out how the share market did today, they can say the ASX 200 went down 1%. Knowing that the top 200 companies on the Australian share market are a pretty good representation for the entire share market, they can say the share market fell today. So what would you use the ASX 200 for? Really? Not that much. In fact, I don't really use it at all. The ASX 200 is really just a way to get a sense or a pulse check on what the market is doing each day. You'll often hear of many different indexes. So the ASX 200 is just an index of the market or an average of the market. There are others around the world, such as the Dow Jones in the USA, the S&P 500 in the USA, the Nasdaq in the USA, the Hang Seng in Asia, or even the London FTSE 100 in the UK. So there's all these different indexes around the world, or indices. The types of investors who are most likely to pay attention to these indices are investors who invest in index funds or managed funds, because typically the index fund will try and replicate what that index is doing each day. So if the share market went up 1% today, the index fund should go up about 1% in that same day. That's the idea of an index fund, to follow the index. So what are dividends? Dividends are the third essential term that you need to understand. I'm going to try and explain dividends very quickly, along with something called franking credits. Dividends are something that you receive if you are an owner of a company. So what do I mean by an owner? I mean a shareholder. A shareholder is an owner of a company. So every 6 or 12 months, those are called the half year or final dividend, every 6 or 12 months, typically the board of directors of a company will sit down, look at the company's financial results and determine whether some of the profit that was made in that period should be paid back to the shareholders. So what actually happens when the dividend is paid? Well, typically the company will make an announcement to the stock exchange saying that we're going to pay a dividend. Now, a dividend is optional, so this is by no means a guarantee that you will receive dividends from your company. That's why it's really important to pick the right companies. But the board of directors will make a statement to the Australian Securities Exchange saying, we're going to pay a dividend of X. And then there'll be a date there which they say, the dividend will be paid on this day. And then what happens is you, the shareholder, can expect to receive either a check in the mail, so a physical check, make sure you check all of the papers that come from your broker. You get a physical check in the mail, which you'll need to take down to the bank, or it will be directly deposited either into your brokerage account or nominated bank account. So how do you nominate to receive the dividend as cash and not as a check? You need to go to either your brokerage account and set your preferences, or you need to contact the share registry. The share registry is another type of financial organization that's not your broker, but another type of financial institution that you need to go to their website and use your information to log in and tell them where you want your dividends to go. Now, you've probably heard about this thing called franking credits. So what are franking credits? Franking credits are, in the simplest possible terms, a tax credit that you can get against your name at the Australian Tax Office. So this is only for Australian companies and it's typically only for Australian eligible investors. So there are some details that you need to understand, which I've included below this video. So what are franking credits exactly? Imagine that the company pays tax in Australia because it has Australian operations and it needs to pay tax. Well, because you own the company, you shouldn't have to pay tax twice. The company shouldn't pay tax and then you pay tax on the dividends because then you're getting taxed twice on the same amount of profit. So in Australia, we have something called the imputation or franking credit system. And what happens is when you or your accountant lodge your tax return, you should note that you may have franking credits against your tax file number. And what happens is the tax credits from these franking credits offset the tax that you would normally have to pay that year. So it's kind of like you pay tax, but then that credits it, and you might even get a tax refund of franking credits. The fourth essential fact about the share market, which you need to understand, is when is tax paid? A question I almost always get every week is, when do I pay tax on my shares? Now, we've just talked about franking credits, which introduce this idea of tax. Because in the share market, you typically benefit in two ways. You benefit from the long-term growth of the share price going up, and you also benefit from any dividends you may receive along the way. You are taxed on both of those things. So let's imagine that you buy a share today for $10 and you sell it in 5 years for $20. That would be a capital gain because you've got the $10 price that you pay now and you've got the $20 price in the future. The difference is $10. That's a $10 capital gain. Now, there are some important, nuances around this. Typically, if you hold shares for more than 12 months, you might pay less capital gains tax than if you made a profit or a capital gain within 12 months. So imagine, for example, that you buy a share today and you sell it in a week for $10 more. That's a 100% capital gain. But if you buy the share today and you sell it in 2 years from now, you might have to pay less in capital gains tax because you held it for a longer period of time. You should refer to the videos below or the ATO website to learn more about capital gains tax. But that's the first type of tax that you'll pay. The second type of tax that you will pay is income tax on your dividends. So if you receive dividends by a check or directly into your bank account, you'll have to report that as income from your investments, and your accountant will know what to do with that. So just like you would if you were receiving a salary from your employer, you pay tax on that. You would also pay tax on your dividends. So those are the two types of tax. Now, there are some really important, nuances and quirks with the tax system in Australia. We've already talked about franking credits. I would encourage you to take a moment and read through the material below and explore some other different material to learn more about tax. Some of the greatest authors in the world say that tax is the biggest expense you'll ever have to pay. In fact, if you pay 30% tax every year to the government, you're effectively working for 3 months of the year just to pay the tax man. So it makes sense to take a little bit of time to focus on how you can minimize that tax while staying within the rules. The fifth and final thing we need to cover is what is this concept called valuation and how does it differ to share prices or just prices in general? Now, to understand what is valuation, I think a really neat example is to imagine that you go into a shoe store and you're looking for a new piece of footwear. Let's say you're looking at a pair of Nike shoes. Nike, the company, by the way, is on the New York Stock Exchange, so you can buy shares in Nike using an international share brokerage account. Imagine you're going into a store and you look at a pair of shoes and you see that it has a price of $100. The pair of shoes is $100. That is the price. And that is just like the share price that you see in your brokerage account each day. The price going up and down is akin to the price of the new pair of footwear that you're looking at. But what is this concept of valuation? Imagine we go into the store and we both, you and I, look at that pair of shoes. It says $100. You decide to buy those pair of shoes, but I don't. We might not think it, but in our brains, what we're saying to ourselves is, I think those pair of shoes are valued at more than $100, so I'm going to buy them. I think they are undervalued. I might say, $100 is a little bit expensive. I think they're overvalued. In the share market, we do exactly the same thing, except there's a little more science behind it than kind of this intuition and feel. What we do in the share market is we look at the fundamentals of a business to determine if it's growing, how much that growth is worth, and then we put a valuation. If you ever read an analyst report, what you'll typically find is something called the target price or the intrinsic valuation. And what the analyst is trying to tell you, the reader, is I think that these shares are worth this price, but the current share price is this. Therefore, I think it gets a buy rating. Or if the analyst thinks that it's definitely not worth what the current share price is, it's expensive, it's overvalued. I think it's only worth this amount. Then what they'll say is probably, maybe we should sell that share now because it's expensive. One really important point on valuation, and I can say this because I am an analyst myself, is valuation is sometimes just as much art as it is science. Even if an analyst says a share is worth this much more than the share price, don't think for a moment that that is guaranteed. When an analyst creates their valuations and their forecasts, they're actually using subjective input to determine what the future might hold. And the future is an uncertain place and lots can go wrong. That's why when I look at an analyst report, I kind of take the valuation with a pinch of salt. And what I'm actually looking at is, what has this analyst actually done to do their research? And what are the different things that I can learn about the business from this analyst? So don't always just go and blindly follow what the analyst says the company or the share is worth. Those are the 5 essential things that you need to understand if you're investing in the share market. As you can see, they're quite in-depth but important topics to understand. So we've attached some really good materials below this video. And there are free courses on our website to learn more about each of these topics. I'm Rask Education from Rask Australia. Thanks for watching this video.